Hello and welcome back. My name is Ryan Hogan. I'm the large cap portfolio manager at the Oregon State Investment Group. It is week 5 of fall term and the current value of our portfolio is $3.37 million. Here's a weekly performance overview. 4.06% versus the 3.86% of the S&P. We had a really strong week. We were underweight technology, and while we do hold Amazon, it is a huge holding in our portfolio. It's not that big relative to what it's held at in the S&P. For this reason, I believe that us being underweight Amazon relative to the S&P and us being underweight technology relative to the S&P was a reason for us to do 64 basis points of alpha this week. It was a good week, but again, we don't want to celebrate too early. This is just a 1 week fluctuation. This moved our year-to-date return above the net down 20% threshold to 19.35% negative. Versus the S&P, we're still within 40 to 50 basis points of the year-to-date return, so we'll keep on our eye on that. Our year-to-date alpha is negative 2.65%. Nothing has really changed with the beta besides our year-to-date beta moving upwards just a little bit. But despite this upward movement, our 1-year Sharpe ratio still lags the S&P 500. But since we've started the fund, we are still beating the S&P. Just by around 4 to 5%, again within that margin of safety. U.S. Treasury yield curve and economic data. GDP numbers came out, and just real quick, I threw up a chart of the GDP numbers. We were in a technical, by definition, recession for the first 2 quarters of 2022. But again, we are starting to build back. So was it a recession? Was it not? The White House is denying that it was, but we'll see going forward. Yield curve, the inversion is still present. It's the lowest delta for longer term maturities that we've seen in months. Again, creating somewhat of a flat yield curve. And according to the Chartered Financial Institute, this curve signals that investors and institutions with money to loan are worried about loaning it in the future, so they decide to loan it in the short term. In the flat yield curve market, investors get the same amount of money or rate of return for short-term investments as they do for long-term investments, loans, or long-term loans, long-term debt. For lenders, since this makes the same return on loans versus the short term, they are less likely to make long-term loans, causing other effects in the market. This is not good. This contributes to volatility and uncertainty. And volatility and uncertainty are the enemy of really any long-term investor. Next Fed meeting, again, is that November 1st through the 2nd, so keep your eye on that. GDP data was released yesterday, and we grew 2.6% versus 2.4% for the summer months of July through September. Here's a portfolio update, and here's some charts that I've just shown. Really, when we face this historical inflation similar to what we're facing today was in the 70s through the 80s. We had the big energy crisis, as well as Paul Volcker being appointed to chairman of the Fed to get inflation under control. And during that period, he hiked interest rates like crazy, and he did not stop. And that put the U.S. into a recession. The stock market drew down 27.1%, as you can see up here. But 1 year after, the market was up 43% because he started to cut rates. And then 3 years after, we were up 81.2%, and so on. And so here's another chart that I've shown you down here. When he was cutting rates, that contributed directly to the growth of the stock market and companies and just overall economic growth. And here's an average of returns from 1928 through 2020, and they parsed these out into categories or buckets of data points where inflation was rising versus falling, versus rising rates versus falling rates. So rising or falling rates didn't really have an effect on the stock market, but falling inflation did. And so when he rose rates, it cut inflation and it dropped it back. They cut down on it, as you can see up here, consumer price index, and that contributed to this abnormal return for the market. This is great news for us because if we're peaking on inflation, or we believe we're peaking on inflation, and the Fed raises rates, continues to raise rates, we can be certain from historical data that, hey, we can't really be mad at the Fed. It doesn't matter too much if they're rising or falling. What does matter is if we're facing rising inflation, which we are currently, or we're facing falling inflation, which I believe we'll face in the future. So it's my opinion that we need, as good investors and as prudent investors, to position ourselves for this. We hope that the Fed tames this inflation, and we want it to fall so we can generate this return. And we want to be positioned, using all of our cash, to position ourselves so that we can ride the wave up. Last of the earnings. So again, I talked about how 800 plus companies are going to be reporting, and now we have midterms. We had technology sector sell-off. We had Google and Amazon miss, and beats from Microsoft, Apple, Verizon, and Intel. Despite the beats on earnings, nobody predicted this from the macroeconomy. Lower energy to 3%. And these are some of my portfolio moves. We're going to lower energy to 3%. We still have a ways to go. Pioneer will not stop making gains. Again, it's tough to cut your winners, but I do this on a weekly basis just to trim. But the problem is when the rest of the portfolio devalues, Pioneer seems to be kind of the one stock that doesn't. And it makes me not want to sell it, but I go to sell it, and then the next week it devalues again, and Pioneer is still maintaining its composure. And so I go to cut it again, and the numbers in terms of percentage sector allocation haven't changed, because I keep making cuts and transferring it to other sectors, and then those sectors devalue, and Pioneer stays the same. Another plan that I have is to raise our material sector to 2.56%. And we already get exposure to real estate through Berkshire and Blackstone. This is great news for us because we don't have an individual REIT in our portfolio, and we don't pay taxes on any dividends. So the dividends we receive from Blackstone go directly back into the portfolio, and while Berkshire doesn't pay a dividend, they keep their cash inside their company to be reinvested at a higher rate of return. I totally agree. I'm kind of indifferent to it because I don't pay taxes on dividends, at least when I manage this portfolio. I don't receive any of the money, but the portfolio doesn't pay taxes because we're an educational institution. Blackstone reported on October 20th and subsequently did 11% last week. Great job, Peter. Peter is an analyst of ours. And this trade kind of got away from us. I'm not going to be buying more of this stock because it's on a rip. It's going up. It's not stopping. I had a great earnings report when every other earnings report was mediocre at best. And I'm just going to let it ride because I believe that you'll see some drawback as rates continue to rise and some of their real estate holdings become less valuable. I have some more notes in here that I'm not going to read, but we'll be doing a lot of rebalancing next week, post-earnings, pre-midterms, dividends and portfolio moves. Just real quick, $1,122 from Cisco. Sold 15 shares of Pioneer for $4,000. We bought 150 shares of Google for $14,500. Bought 100 shares of Verizon for $3,643. We bought 100 shares of Microsoft. This company beat, and I think I said in one of my previous videos, you'll see companies like Microsoft, companies like Apple, they'll beat their earnings. They'll do extremely well, but they'll sell off because everything is top down, not bottom up right now. Nobody cares if you beat. It's all focused on the Fed. And so we bought a block of that stock for $4,692, lowered our cash position to $57,452.86. I think, putting some of our cash to work throughout the week. We had a great day yesterday and the day before. This kind of helped us outperform the S&P this week. But again, we want to refrain from really putting too much emphasis on the week-to-week performance. It's good to be knowledgeable of that, but what we really care is the inception performance and the alpha that we're generating for our portfolio beneficiaries. So we have 28 holdings plus cash, and moving on. This is a 5-day view of the S&P 500 post earnings. Every other sector was bought up. You can see consumer defensive, energy, industrials, healthcare, financial, basic materials. All these sectors were bought up. Investors want more. What they want less of is Microsoft, Google, Meta, Amazon, Verizon. And these are the exact names that I want to be buying on the dip, because I think these are relatively well-positioned companies. Besides Meta, I think they need to kind of rein in some of their capex before I look at them. But a lot of these companies sold off, and they're good quality companies. So we'll see going forward. Even Tesla was up 8%, 60 basis points, doing well. A lot of these other names absolutely blew it out of the park this week. So as always, thank you for tuning in, and I'll see you next week.